Okay, so as we have our guests joining us, I'm going to go ahead and start with, again, who we are, Blue Heron Financial Group, and we are located in Annapolis, Maryland. This is our 28th year of Blue Heron, and I had just mentioned it is our 25th year working with Northrop Grumman employees across the country through their wealth management channel. So we're delighted to be able to provide this presentation to you all today to give you some insights into the market. So I'm going to turn it over to Sarah to tell us about our speaker today. And thank you again for joining us.
Very good. Good morning, everyone. We are very excited to have Walt Seisky from AllianceBernstein. Walt serves as the Senior Vice President and Senior Investment Strategist for Equities at AllianceBernstein. He rejoined the firm in 2015 and has been in the investment management industry since 1986. His roles have ranged from a fundamental equity research analyst and portfolio manager to chief investment officer. Prior to rejoining AllianceBernstein, he worked on the buy side for Regions' financial predecessor organization, as well as at Commerce Trust Company and Bank of America. Walt holds a BSBA in finance and an MBA from both from St. Louis University. He is also a CFA chart holder. So without further ado, Walt, we will turn this over to you, and we are excited for the presentation. I know both Margie and I will be jotting down our own notes as well as those on the call this morning.
Thank you so much, Sarah and Margie. Appreciate it. And thank you all for taking time out of your day to join us. It's always a pleasure to share our insights, which just as a bit of a disclaimer, we do this every quarter. And so a lot of the data that you're going to see is as of June 30th, but I'll be providing some news headlines along the way because things have been changing quickly, thankfully in the right direction. The markets continue to march higher, the equity markets, that is, while the bond markets are staying in a bit of a trading range. But nonetheless, we're seeing the markets react to some of the headlines, which earlier were a little more fearful. More recently, they've been embraced by the markets in a positive way. And Sarah, just from a housekeeping standpoint, does the slide look okay? And am I coming through okay?
Yes. Yep. Everything looks good.
Thank you so much. So without further ado, let's talk about what's been going on. Just a few things. So the title of the presentation that you saw earlier on this slide was called Red Light, Green Light, Yellow Light with a question mark. So the red light, green light, for those of you who remember, I certainly do, there was a game of tag where you would say red light, green light, and you would tag and somebody was effectively it. That's how we got the catchy little title here. But what you're seeing is a number of headlines. I'm not going to go through every single one of these, but this is just highlighting some of the tariff news that has been swirling about. It continues to this day, starting from January 20th in the upper left-hand side, where the president said he was going to institute 25% tariffs on Canada and Mexico, all the way through in the lower right-hand corner on June 29th, where the president announced that trade talks had restarted with Canada. The point is it's been very fluid. The red that you see on the screen is like, oh gosh, that's maybe not good news, and the markets aren't going to like that. Where the green was, okay, we got a bit of a reprieve here. The point is you could get whiplash trying to keep up with all these headlines, but nonetheless, the markets have continued to advance as we're making some favorable progress over time. And this is why, if there's a good reason why you're working with Sarah and Margie, it's in times like these that the amount of uncertainty that's been about in the markets has been high. But the good news is the range of outcomes is beginning to narrow. And I'll come back to that in just a minute, because we've already gotten some things known or unknown is behind us, which is the One Big Beautiful Bill Act. More on that in just a little while. But so how have the markets reacted? So what you see here in this blue line is just the Standard & Poor's 500 index, a very popular stock market index, and I'm sure many of you are familiar with. This goes from the beginning of this year through June 30th. That is the blue line. And again, we intentionally put a lot of different headlines here, and those that are shaded, again, go to tariff announcements. The point is, any conversation I've had on the capital markets begins with policy. That is, what's going on with tariffs? How do you see this developing? What's going on from a fiscal policy standpoint in terms of the One Big Beautiful Bill Act? What does that mean for debt and deficits? Are people backing away from the treasury market? That is, for investors, are they not buying our treasury securities anymore? That's every conversation I've had. And guess what? The markets have reflected that too. We've seen some zigging and zagging as we're working towards what we call a process of the economy normalizing, meaning that eventually we do think inflation and interest rates approach a level a little more closely than what we saw before the pandemic hit. But this is what's been going on. You got road to what we say normalization isn't a straight line, but the good news is we're making some progress on that front. And as I alluded to before, we're seeing that reflected in market performance. Speaking of market performance, and again, this is as of June 30th, as I mentioned earlier. On the left-hand side, what we're showing here is just returns for various different markets. On the left of first in the blue box, we show equities. Below that, we use the term credit. That is anything from high yield bonds to corporate bonds to government bonds that we show on the bottom. And we broke this into three different periods. The first column that you see of those bars for respective equities, credit, and government bonds is the year-to-date returns, again, through June 30th. In the middle, we show since the president's inauguration, what the markets have done. But look at the boost here. Since the Liberation Day, this is April 9th. A quick story, Sarah and Margie, when we did our national call, we do it to financial advisors such as yourselves every quarter out of New York. This was April 9th when we did our call. That was the day the administration effectively said, well, these reciprocal tariffs, let's pause that for 90 days, right? Let's extend that. And they've been extended again to August 1st. And but look at just how the markets responded. Again, the point that tariffs have been driving the markets, the S&P 500, that's what we're showing here, up 10.5%, just as an example. And you saw the credit markets post some positive returns as well. So that's what's been driving it. But as I said, we're starting to see the range of outcomes narrow, which is a good thing because none of us like uncertainty. I always use the line surprises. That's fine during the holidays or maybe our birthdays. But when it comes to our investment returns, we don't like surprises. We want certainty. And we're trending in that direction. So let's talk about what's top of mind for the Federal Reserve. And I mention this because interest rates are so critical to returns, not just in the bond market, but also the stock market. So what I'm showing here, think of this as if there were a terminal at the Federal Reserve, if there were monitors, these would be some of the things they would be looking at on their screen. Look at this in terms of gauges. So it's looking at three things from left to right: inflation, the growth in the middle. Here we mean economic growth, and on the far right-hand side, we mean this. We're speaking to the labor markets, the job markets. And every one of these squiggly lines that you see in these respective boxes, think of this as their temperature gauge or fear gauge, meaning that the higher the blue line here for inflation, this is just gauging the Federal Reserve is thinking inflation's a problem. But on the last reading, you have to squint a little bit through the end of June, it fell lower. And the inflation data that we've seen so far has not been problematic. So their fear or concern here is starting to lessen. That's a good thing. If we go to the middle, economic growth, the lower this line is, the more they're worried that, oh my goodness, the economy is really getting slow. We might be going to a recession. If it's going up, as it is here, they view less risk. It just, spoiler alert, we don't see a recession. I'll get to that in just a little while. But the Fed is not fearing that the economy is going to careen lower or crash. That's not what the Federal Reserve officials are seeing. Again, a good thing. The jobs market last. This is one where we're starting to see the labor market cool down a little bit, but it's not falling off a cliff. The term that they use is that it's an equilibrium, not too hot, not too cold, because we still have a fairly healthy jobs market. In fact, the jobless claims came out today below expectations. So we're not seeing signs of cracks in the veneer that the job market's in trouble. So consequently, the Federal Reserve isn't that concerned about it. Again, these are three things we call it the Holy Trinity that they focus on: inflation, growth, and the labor market. Let's turn to inflation. Let's dig a little deeper. What you see here on these bars is just looking at inflation in four buckets. I'll begin on the upper left-hand corner, food prices. We can all relate to that. And I want to be clear. We know we are paying higher prices for things since pre-COVID. That is a fact, undeniable. But what this is measuring is the year-over-year change in these respective categories. And if that year-over-year change is lower and lower, if these bars are smaller and smaller, that's what the market focuses on. They just want to make sure it's not continuing to spike higher and higher. And yes, we are paying more for eggs, apples, you name it, at the grocery store, but we're seeing these bars get slower. In fact, the year-over-year change is 1/4, 1%, which is in line with what we saw before COVID from 2010 to 2019. We see a similar pattern for energy prices. Those could whip around quite a bit, but again, closer to the pre-COVID average. Goods in the lower left corner, think of this as anything that we buy off of Amazon or bigger ticket picture purchases such as furniture, a car, a boat, you name it. Goods prices have been well behaved. You think about what happened during the COVID era back here in 2022. Many of us were sheltering in place. There was a lot of stimulus money for a lot of people. They were buying stuff. They're just not buying as much because their demand has been sated. And again, the change in goods prices overall is in line with the long-term average. The sticky wicket more recently has been services. And what I mean by services, that could be anything from concert tickets, airline tickets, hotel fees, haircuts, car insurance, car repair. It's a big bucket, but a big bucket part of this is housing. And it's 30% of the inflation in this services category is the housing market. And we've seen housing prices come off the boil. And consequently, these teal bars in the lower right-hand corner have getting smaller and smaller. Again, we think we're on this road to what we call normalization, where inflation gradually gets back to what it was before the pandemic. It's going to take some time, but the market is starting to detect this and responding positively in turn. So what do we need to keep an eye on? I talked about the Holy Trinity earlier. Let's talk about the jobs market. I mentioned that when we look at non-farm payrolls, this is the unemployment rate, this blue line on the left that I'm showing here. Again, it spiked during COVID. It's come down dramatically. We're still a little shy of north of 4% unemployment rate. It has dropped like a stone. That's good for the economy. A healthy jobs market means a healthy economy. If we look at here in the middle, I'll call out a couple of things. This hiring rate, this gold line that you see, it's dropped. In fact, when we talk to company managements at AllianceBernstein, if it's chief financial officers or CEOs, during COVID, if you go back to 2022, the rhetoric that they were saying was, we can't find people. We're having a high, so we're looking to hire a lot. They're not hiring as much. But again, don't fear, because if you look at this purple line, the layoff rate that I'm highlighting here, we're not seeing widespread layoffs. Yes, there are pockets, there are exceptions, but they're not spiking. That is a good thing. So we need to keep an eye on this. We don't expect this to continue, but we eventually think the labor market continues to gradually cool because the hiring rate is going lower. What do we need to watch for economic growth? I would say a couple of things. When you consider that the consumer, all of us on the line here, represents about 70% of the US economy, we matter. And we've seen a bit of a slowdown in consumer spending. This is what this middle line is showing. It has slowed. But as I mentioned, consumer spending has still been fairly healthy while it's slowed up the boil. And as consumers, we're always going to buy things. I make the joke that the U.S. consumer has been written off many more times than Enron's debt. Margie, we're talking about y'all been doing this for 25 years. I've been at it a while too, but we have to pay attention to it. But yes, it is slowed, but again, it's not at a rate that gives us grave concern. But we have to keep an eye on it. And I think a lot of this was due to tariff uncertainty. But more recent retail sales, and again, this is as of June 30, have been perking up because more and more trade deals are being signed, and we've got the One Big Beautiful Bill Act behind us. So again, we got to watch it, but not hitting alarm bells here. What about economic growth? Well, what we've seen is new order activity. I'll call out just here in the middle. This is on the basis of service-oriented businesses. I talked about some of those, if you're hotels, et cetera, to manufacturers. New order activity had slowed quite a bit because what they did before, they were fearing that these tariffs were coming down the pike. They loaded up on inventory. A lot of manufacturers, a lot of service companies, so they had enough to get by. So we've seen new orders slow. If this were to continue, that's something that would get our attention. But again, as we're seeing more and more reasonable trade deals being struck, we don't think that this is going to crater all the way, through the center of the earth. We just don't see that happening. So where does this take us? A lot of numbers here, and we publish this every quarter. On the left, you see different regions of the world. We highlight here in blue in the middle the United States. And these columns, when we say real growth, we mean how fast is the economy going to grow? We don't see it growing that quickly this year. It's about 0.5%, but we do see it start to pick up next year to about 1.5%. And this is after inflation for economic growth. Inflation, I'll call this out for this year and next. We think it clocks in at around 4%. And because a lot of that, we're assuming that you were going to see a bit of a bump up in tariffs that drive that higher, but then gradually going below 3% next year. So this is where we stand. Again, I said before, not a recession, but we think we're going to gradually get back to inflation rates that what is similar to what we saw before COVID, as well as economic growth rates. We're trending in that direction. So let's pivot now to the equity markets. I mentioned the Standard & Poor's 500 index before. Yes, it's roughly 500 stocks, but if one were to just naively buy that through, say, an index fund, et cetera, and I'm not here saying that indexing is a bad thing, it has a place, definitely. But we call this out to say that you may not be as diversified as you think, because this purple line in the middle is showing, if you take the top 10 biggest companies in the index, you look at if it's Microsoft, NVIDIA, et cetera, the top 10 biggest stocks in the index represent 37% of the S&P 500. Just 10 companies. That's it. So a lot of people will think, well, I'm really well diversified. Well, over a third of that is just in 10 companies. And if things start to change for them, you don't want to be that exposed. But what's interesting is, if you look at the Magnificent Seven stocks, many of you may be familiar with that. Again, this is NVIDIA, Meta Platforms, formerly Facebook, Tesla, Amazon, Alphabet, formerly Google, Apple, Microsoft. If you look at how they performed in 2023 through 2024, they trounced the S&P 500 index. That's shown here in black. This is just showing the rate of return for those stocks for 2 years. But if you look at this year, I'm submitting that the Magnificent Seven are becoming the Divergent Seven. If you look at their return patterns in the first quarter of this year, only Meta, aka Facebook, outperformed the S&P, which was down 4.3%. All the others underperformed. So the Mag 7 became the Lag 7 in first quarter. And in 2026, yes, they had a bounce back, but Apple has been lagging the S&P. Tesla had a bit of a bounce back. But my point is, the stocks are acting differently. They're not trading as one basket. This is where you have to use a lot of judgment as an active manager and size your position accordingly and choose, because this trajectory of all these stocks beating the market handily, we don't think is going to continue. Doesn't mean that's a bad thing for these companies, but there are other opportunities that we can look at. Now, again, another busy chart, but think of this as a roadmap to who was best insulated from tariffs. We talked a lot about that earlier. And on the left here, I'm showing certain industry groups that what I'm calling the tariff tolerant. And this could be anything from commercial banks. If we're doing banking, that's a service in the US. It's not a good. So they're not going to have to worry about tariffs. So I show the industry group, I show the key drivers as to why we think they're better insulated. And then I get the question we get is this a growth or a value segment of the stock market? Historically, things like commercial banking, electric utilities have been in what we call value stocks. That's why I use the term lineage. So you have that group that are tariff tolerant, all the way down to tech and software services companies. Why? If you think about Microsoft, those of you who use it, it's a recurring business model. It's a subscription. You're always going to renew that, right? If you're a business or a personal user. And typically those stocks reside in the growth camp. Now, what's behind this is the One Big Beautiful Bill Act that I mentioned. Who benefits from that? Well, think of it. If you're a defense contractor, Northrop Grumman is a good example. I show that on the first line. That's coincidence. It wasn't intentional, but they spend a lot of money on capital spending, a lot. So what does that mean? They could write off 80% of their capital spending immediately. What does that mean for the share price? There's a lot of free cash flow that starts to go higher because they could write off that depreciation. And when free cash flow of a big industrial company like that happens, it has a ripple effect throughout the economy in a positive way. Commonly, those have been thought as value-oriented stocks. All the way to here to highlight wireless infrastructure. There's a lot of FAA system upgrades that are in place. These are some of the cell tower companies, some of the testing companies to make sure that the cell signals are getting through quickly. That tends to be more growth oriented. I can relate here to the FAA system upgrades because I fly and travel a lot. And on-time flight in this environment has been an endangered species. I'll take it. Anything that can enhance the flight experience to make traffic less congested, I'll take that. But think of this, again, as a roadmap of some of the companies in industries that are likely to benefit from this environment. And then that transitions to the question, if you're an investor, should you be value or growth? And the answer is yes. To use a sports analogy, there's a lot of shots on goal here that you can implement. If you're in the value camp, we like the financial services companies, the industrials. I mentioned that earlier. And below that, we show the industry that we like. Because if you look at the earnings growth in these value categories, it's north of 12.5%. And a lot of people think value is a very slow growth, stodgy part of the stock market. Au contraire. Especially when you're seeing a lot of onshoring and nearshoring activity. Some of these industrial and some of these independent utility companies are growing their earnings anywhere from 15 to 17%. So we're finding a lot of opportunities there. And the same for the growth areas, be it communication services, this is the Metas of the world, and even healthcare, which has been a laggard this year, but we know demographically there's going to be a need for that. There's been a lot of policy headlines that have weighed against that sector, but there's a lot of ways to win there with very healthy growth rates north of 14%. But it's not limited to that. If we go to what's going on, especially with artificial intelligence, there's a couple beneficiaries that we see. Power demand, if you look here on the left-hand side, from 2020 levels, it's projected to grow four times. That's a 38% annual increase. That is a lot. And we have to fortify our grid. There's a lot of investment dollars. And guess what? Here's the good thing. We talked about policy. There's bipartisan support for this because we know that we need to make our infrastructure stronger, whether you're driving an electric vehicle, powering internet to the home, or to run data centers. It requires a lot of power. The other part, when we look from an onshoring perspective, is that the factory automation. Not that robots are going to take every job, but it is a lower cost option. This is showing the growth here in the middle, the global industrial robotics market. It's growing at close to 12% a year. We're finding a lot of companies who make components, who actually manufacture these, selling into the power. And if we look at some of the areas here on the far right, I'm showing here the year-over-year earnings growth. If it's semiconductors, if it's electrical equipment manufacturers, you can see that these earnings growth rates are north of anywhere from 12% to 27%. Why is that important? Well, it's projected that the S&P 500 earnings growth is 7%. These are growing a lot faster, which we think makes for very exciting investment opportunities. Let me finish on international stocks, and then I'll transition to the fixed income markets. International equities, for the longest time, really since 2007, have lagged the S&P 500 index. But this year, they are outperforming handsomely. This is the whole need of taking that long-term view, maintaining diversification, because there's going to be a time in the season for different parts of the capital markets. We're starting to see international stocks do well, as I mentioned, and we don't think this is a head fake. Here's a couple reasons why. What we're showing on the left-hand side is that this is an international stock market index. Again, many of you may be familiar with the EFI index. That's what these blue bars are showing. Earnings growth for 2025 The second blue bar is showing earnings growth for international companies for the first half of 2026, next year. Next to that in the gold bar is the same each period's earnings growth for the S&P 500. The takeaway here is the earnings growth for a lot of these international companies is very competitive with the US markets. Yep, the US exceptionalism, it's still here, but these companies are doing well. A couple of things I'll mention. Germany is spending more money in terms of their military defense. In some cases, they're transitioning, true story, old Volkswagen plants to make military defense equipment. That's a big multiplier effect for an economic standpoint and profitability. So we're seeing competitive earnings. The other in the middle here is the US dollar. It has weakened this year. And a lot of that owes to the fact of a lot of policy uncertainty with tariffs. Yes, our debt to GDP is growing. And not that the dollar is ever going to be displaced as the world's reserve currency. We do not believe that. But it's still expensive relative to its long-term average. This gold line that we're seeing here, again, we don't think it crashes, but we think this blue line, that is a weaker dollar, is if it gets closer to the long-term average, that's a tailwind for us in the US who are buying international equities. That is part and parcel of why they've done so well this year. Strong earnings, a weaker US dollar. We think it still makes sense. It's not too late to get on board there for those of you who haven't. Finally, I'm going to wrap with just a couple of comments on the fixed income markets. We've gotten a lot of questions about how are the bond auctions going? Are people backing away from our debt? And the answer is no. This blue squiggly line on the left is just showing an indication of demand. The lower this line, the better. And it's at the long-term average. So when we're auctioning Treasury securities, the people coming to market to buy them is in line with the long-term average. We've seen no evidence of people saying, we don't want to buy US Treasury debt. The other question we get is, what about foreign investors? Are they dumping our view? Is China selling all the treasuries as an example? What this line in the middle is showing is that's not true. The higher this line, this is a gauge of foreign demand for our treasury securities. It's well above average. We've seen no evidence of that, none. Again, we're the most liquid market in the world. The bond market's acting and facilitating in a very healthy manner. So where are we finding opportunities? First, I'll start with taxable bonds, the high yield market. Let's focus here on the right-hand side. What this is showing is in prior periods of market stress, when the yield on the high yield markets was very, very high above treasuries. Let's just look at 2008. It was a 22% yield advantage to treasuries during the credit crisis. The gold bar next to it shows what happened over the next 5 years on average. If you invested in high yield securities, your rate of return annually over the next 5 years was north of 20%. We show other periods in time where oil markets sell off here, up 9.2% treasury yield spread. Your next 5-year return was 9%. You could still get 7% in the high yield market. Think about that. We would have been climbing big privacy fences to get yields like that where it made sense. It's an undeniable symmetry. And if we're right, the next 5 years, taking a 7% return on this asset class, not a bad place to shop. And lastly, the tax-free bond market. The yields there are very attractive. That's a market that's lagged for a number of reasons. One of which being some of the speculation that the tax exemption on municipal bonds would go away. That's been shelved. We don't think that happens. But if you look at the yields, let's just look at the high yield muni market. Earlier, on the prior slide, I said if you look at high yield corporate bonds, a 7% yield, if you're in the highest tax bracket, high yield munis are getting you close to 10%. And if you still want to stay with investment grade or triple B, you get 8% after tax versus buying a corporate bond at 5.2%. That's the yield you're getting today. This is an opportunity, and if we're right that the Fed continues to lower interest rates, which we suspect they'll probably start in the back half of this year. They've held off this year after lowering rates about 100 basis points in 2024. Yields eventually go down. When yields go down, bond prices go up. We're saying take advantage of this both in the municipal market selectively as well as the high yield market. So three things. And then Margie and Sarah, I'd like to turn it back to you for any closing comments that you might have. We don't see a recession. We are getting through a lot of this dizzying array of policy headlines fairly well. We're finding opportunities both in the equities as well as the taxable bond markets. Think of this in terms of the value and growth. You got opportunities abundant, taking advantage of the AI theme, and high yield and munis in the fixed income market, given where rates are right now, very compelling returns opportunities. So Margie, Sarah, let me turn things back to you.
Thank you so much.
Yes, well, that's great. I know I could listen to you all day long, and
Oh, thank you.
we will be sensitive to our audience. And in addition to some of that, the bullet points, I had written down a few myself, and I just wanted to share those. As far as inflation, it sounds like, yes, we may be poised to see that pop a little bit here, but not to get out of hand. And as we make our way through 2026, to actually see that then drop back down. Also, Mag 7 has been such a story for a few years now. And we talked about this offline as well. There's these tentacles of that, those stories that are supporting the AI stories, for example. So I think that's really a big point. We always have to be careful not to fall too in love with those big names, and to make sure that the diversification is always in place in our portfolios. You touched on the economy, and yes, and I like the slide, we take a look at some of those emerging market areas, whether it's China or elsewhere, but their economies are not the size of the United States. And my big takeaway there is the US is still growing, it's still moving. Consumer spending, yeah, we had such a spike in after COVID, because that's all there was to do, is to
It's true.
order your next purchase, and to see some pullback in that. But the American consumer is alive and well. International, that has done splendidly this year, and my takeaway there is that story is not over. So I'm glad for the clients that we work with. We have maintained an international position, and sometimes we get that question over the years, like, well, why do we have this position, not necessarily international, because we don't know when that's going to take off. So we're very pleased that that's part of our overall asset allocation. And I can't stress enough the importance of diversification, not only for lowering risk, but as asset managers, especially for our pre-retirees and retirees, that we have places to go in the portfolio to create the required distributions they may need. Hopefully it's for the fun stuff in retirement, but it's also for, what may be necessities. And the last one, back to the international, I may have to borrow that. This is not a head fake. I like that. I like sports analogies anyway.
Yeah, awesome.
Yes. So I neglected to also thank Will Davis, who was able to get this set up for us, and to have Walt on as our guest today. We are just so delighted for the information that you're bringing to us here at Blue Heron, and that we can also share that across the board with our Northrop Grumman employees that we work with, retirees, our longtime clients, and for all the guests who are on that are just coming to find out more about Blue Heron Financial Group. We want to, again, be sensitive of your time. We know it's lunchtime, at least here on the East Coast, and we thank you so much. We will be publishing this, Sarah, and well, I won't pin you down for time. Yeah, but we will have this on our website in the not too distant future, and it can be shareable also from that point. Good.
Very good.
Great. Again, thank you so much to Will, to Walt, to AB, AllianceBernstein, and thank you, Northrop Grumman Federal Credit Union, for our long-term partnership, and for everyone for your time today. Have a safe and wonderful rest of your summer, and we'll look forward to seeing you again soon.